So the number one question people have been asking over the last year or so is whether or not the Fed will be able to engineer a soft landing. Whether we'll have a soft landing to this recession or whether we'll have a hard landing. Now, the problem with that framing, of course, is that there assumes that there will be a landing. I'm Jack Gately from Jack Gately Real Estate and the Online Real Estate Academy. There is this overwhelming assumption that this is as high as rates can go. Now, if you went back to my video archive before the mini banking crisis in March, I actually predicted that rates would go as high as 8, maybe even higher than that. Remember the other day I was walking down the street and I saw an internet friend of mine and I said, 7%, that's historically kind of in the middle. That's normal if you take a long historic look at the situation. But what if there is no landing? Has anyone actually considered that? Remember, I'm no economist. I'm just one guy in his office trying to figure this all out. But I do know one thing about conventional wisdom. It's almost always wrong. And the elites in this country, they don't have a very good track record over the last couple of years, do they? So when they told us that it was going to be transitory, inflation was going to be transitory, they really hurt their credibility going forward. And when you look at what's happening in the economy right now, you've got to start to ask yourself, maybe there actually won't be a landing. Last week we had the Consumer Price Index, which came in rather middling at core being 4.7. That is pretty far away from the 2% goal, the stated goal, that the Federal Reserve has, isn't it? And it's not really moving towards their 2% goal. Today, we had retail sales come in hot. And since last Friday, we have seen mortgage rates go up significantly. Let's take a look. From Mortgage News Daily, they have their 30 rate average at 7.24, which you can see is one of the very highest numbers that we've had in the past year. That exceeds what was there in July. And it basically is almost as high as where it was last October. That is consistent with the 10-year Treasury note. 10-year Treasury note, CNBC. Also, you can see it's at 4.2, 4.211, 4.213. That is also one of the very highest rates we've had in the last calendar year, exceeding what we had in March before the mini banking crisis, and just about tying where it was last October. Do these charts look like rates are going to go down? No, they don't. Now, of course, I'm no genius, but I actually am staying at a Holiday Inn tonight, so maybe tomorrow I'll be a genius? I don't know. Now look at the price of oil. As you can see here on the 1-year chart, and we can actually go to maybe just the 6-month chart, whoa, in the last couple of months, oil is on its way up, isn't it? Oh my, and that is going to show up in the CPI print for next month, right? That's, this has been on the march since basically late June. And so a little bit of that showed up in our CPI report, but a lot of that is going to show up on our next CPI report, which probably will come in hot. And as I mentioned this morning, retail sales came in hotter than expected. All credit to Matthew Graham over at Mortgage News Daily for this post, What Do Bonds Care About Right Now? And under the no landing scenario, I think this is the money quote. Some analysts see the past 2 months of lower inflation readings as a temporary blip caused by a correction from an overdone spike in fuel prices. They see recent increases as more sustainable, especially in the no landing scenario. And sustainably higher energy prices would prevent annual inflation from making it back to 2%. In plain language, the rate hikes really haven't gotten us back to 2%, and now we're going to see energy prices rise, which means likely that overall inflation is going to come back. And what's probably the number one factor in this? Spending. Government spending and the printing of money. Matthew Graham again. The supply issue in treasuries is a tough one. In other words, the government's going to continue to print money. Any discussion about trying to get the U.S. government to either stop printing so much money or start taking in more revenue seems like it only exists in jest, regardless of political strife. In other words, the nice folks north of Richmond are going to continue to tax you through inflation, because basically that's what inflation is. It's a hidden tax. And you're going to pay for that by buying eggs or by buying mortgage money. Same thing. Meanwhile, I just saw Kramer on CNBC basically have a cow because Fitch is warning that it might have to downgrade dozens of banks, basically step down the entire banking industry from one level of rating down, to take the whole thing down, which for the top level banks would be not a good thing, like JP Morgan, Bank of America, but it would be really bad for those that are kind of on the bubble, so to speak, on the lower tier of those ratings. What would that mean for government spending? It would probably mean another bank bailout. Oh, Jack, but when Silicon Valley and First Republic and Signature, they were not bailed out by taxpayer money. Oh, okay. Well, actually how that worked was they were bailed out by FDIC money. Where does the FDIC get it? Oh, they get it from the evil banks. The other banks had to pay. Where do the banks get it from? Depositors. In other words, you and me, the American people. So, yeah, it wasn't a taxpayer money bailout. It was just an American people bailout. So we'll probably see more of that, and that's definitely inflationary as well. All right, I'm Jack Gately from Jack Gately Real Estate and the Online Real Estate Academy. We will keep you posted. I'll probably be smarter tomorrow when I wake up at the Holiday Inn Express in Connecticut. Maybe these videos will get better. Who knows? In the meantime, have a great day.